statements, while some of you might want a refresher. So before we go in depth into exploration activities, just some basics of financial statements that we will go through. Now, why is all this important? And this happened, about 15, 16 years back. And this is Royal Dutch Shell. So here, this was the headlines in the papers. Reserve shock wipes 8 billion pounds from value of oil giant Shell. And what happened in early 2000 was that Shell actually made a disclosure, and they said that they're going to recategorize about 3.9 billion barrels of proven reserves into probable reserves. And what that means, as you would know, is that what they said was proved reserves is no longer proved. You may not find oil, and they reclassified it to probable, and that had a huge impact on its market valuation. So financial information will give you historical information about what the company has done, but is also the basis of valuation. And obviously, when you move from proved reserves to, say, probable reserves, it means that not all of those activities that you're doing may result in finding oil and producing and selling, generating revenues and profits and so on. But if we think about the oil and gas sector, we have the upstream activities, which is about finding oil and gas and lifting it, processing it, and so on. So all the exploration activities, the production activities are in the upstream business. A lot of uncertainty around that because you might incur huge amounts of cash expenditure, but not actually find oil or reserves at the end of it. So there's huge amount of risk, but obviously, when you are incurring costs, what do you do about those? What is the impact of that on the financial statements is what upstream exploration activities accounting is about. Midstream is about storage and transportation from plant to refineries. And then you have the downstream part, which is the refining and conversion to final product to be used or sold in the market. So upstream, midstream, and downstream, we are going to focus here only on upstream, the exploration activities and the different impacts you could see on the financial statements. But as I said, before we go into the details of that, let's just do a quick recap, refresher, go through what are the key elements of financial statements. Now, as you do any business, you are generating revenues, you are earning money, and you are spending money. So what the income statement does is effectively tells you how much money you have made or perhaps how much money you have lost. So this income statement is going to tell you about your profit or loss. Yeah. And it's very simple. What is your profit or loss? It is basically your sales or revenue less the costs. Yeah. So how much have you earned? How much have you spent to earn that money, sales or revenue, gives you profit. Yeah. So what the income statement is also referred to as is a statement of financial performance. And it is always for a certain period. Generally, it's 1 year. but you could have interim reporting, which is probably 3 months or 6 months and so on. Yeah. So income statement tells you how much you have earned in a period of time, generally 1 year. The statement of financial position is also referred to as the balance sheet. And it has 3 key elements: assets, liabilities, and equity. Equity is a bit like, what is your net worth? Yeah. So I'll give you a very simple example. Let's say you buy a car. So the car that you bought is your asset. Yeah, it has value. It is your asset. But if you've taken a loan from the bank to purchase that car, then that loan is a liability. So if the car is worth, let's say, for example, 5 lakhs and the loan is 2 lakhs, 5 lakhs is your asset, 2 lakhs is your liability. And in a balance sheet, what you have is a fundamental thing wherein your assets, let's say A, is always equal to liabilities plus equity. So liabilities and equity are how the business is funded. It can be funded through loan, or it could be funded through equity investors. Yeah. And then you have the cash flow statement. Cash is very important. Eventually, if you run out of cash, you can't do business. But you also will find, as part of financial statements, a disclosure of or a presentation of the different sources of cash and also the uses of cash. Yeah. So when you carry out your day-to-day activities, upstream, midstream, or downstream activities in an oil and gas company, you will have a cash flow statement, and you will be earning cash normally from operating activities. And then you might also use cash to invest. So investing activities, and then you have financing activities, which is to do with borrowings or raising funds and so on. Yeah. So operating activities are your day-to-day activities of running any business. Investing is when you invest in buying another business or buying assets, or you invest in oil rigs and so on. And then financing is raising funds, repayment of those funds, and so on. But basically, if you think about any business, you would expect to see these statements. You would want to know what is their performance been like, what is their financial position. Remember, the financial position balance sheet is as at a particular date. Yeah. So it might be 31st March, for example, or 31st December. And cash flow statement is again for a period, just like the income statement, which is also for a period. Yeah. But we will look at some examples on these. So just focusing a bit on assets, because that is what exploration activities has got to do with. Now, you might recognize these people, especially the person on the left. Now, the question is Amitabh Bachchan an asset when it comes to financial statements, for example? Now, if you think about how Amitabh Bachchan would work, he would probably work with a film producer and get paid for that film certain amount as fees, probably a huge amount as fees. So if you think about it, nobody owns or nobody controls Amitabh Bachchan. Nobody owns or controls actors, film actors, right? They operate a bit like how you provide consulting services. You provide your services over a period of time, generally a few months, maybe a bit more than a year, and you get paid the agreed fees as per the contract. So there is no asset here because there is no ownership or control. If you look at the person on the right, Cristiano Ronaldo, who is the football player, Now, would he be an asset which would be on somebody's balance sheet, an entity's balance sheet? Now, in football, European football especially, there is a transfer market. So, for example, Cristiano Ronaldo, may have played for one club. He gets transferred to another club. Say originally, I mean, he's with Juventus, but he played for Man United, got transferred to Real Madrid, and Real Madrid would have paid Man United club a price to purchase him. Now, as such, Cristiano Ronaldo is not owned by the club, but in a way, the club controls Cristiano Ronaldo. So clubs control football players because football players can't just one day say, okay, I'm off. I don't want to play for that club. It's almost like they have a contract for 3 years, 5 years. They get paid huge amounts of money, but the purchase by one club is through a payment. So that is an asset. So for example, if Real Madrid paid, let's say 50 million euros to purchase Cristiano Ronaldo from Man United, that 50 million euros is effectively a payment for right to use the services of Cristiano Ronaldo. And that would be an asset. Now, the contract is 5 years, then over a period of 5 years, that asset value will go down. But it's the right to use services. Not strictly you would say that the football player is owned by the club, but they are controlled by the club. Yeah, they can show their disinterest, but they can't just leave the club. So what an asset is something which is valuable, something which generates economic benefits for the organization. Yeah. And by having Cristiano Ronaldo for 5 years, any club would use their services, win matches, get more sponsorship revenues, sell their merchandise and all that. And hence there are future economic benefits. So the key thing to remember about assets, we recognize an asset when we expect future economic benefits. In the oil and gas industry, we would recognize assets, especially in the upstream, when we expect to generate oil and sell it and through a process, but sell it and then get revenues. So that's when you recognize an asset. If you, for example, carry out activities and find that the hole is dry, you have a dry hole, then effectively there is no asset because you're not going to generate any future economic benefits. So one of the key elements for assets is that you need control and you need future economic benefits. Yeah. So when you recognize an asset, you also find that most assets reduce in value over time. Let's take a simple example before we go into what you can see about infrastructure assets. Let's say you buy a car. Yeah, you buy a car and you think that you will be able to use the car for 7 years. So if you buy a car for, let's say, 7 lakhs or 700,000, you expect to use it for 7 years and then sell it or get rid of it. Let's assume its value at the end of 7 years is 0. So you have a car which you purchased for 700,000 or 7 lakhs, and that would be your asset. And what you would do is every year you will reduce that value, because as you use the car, as time goes, the asset's value goes down. So next year you might say its value is not 7 but 6, after that 5, and so on. So that reduction in value due to normal usage, wear and tear, is referred to as depreciation. Whether you call it depreciation or depletion or amortization, it is the same thing. It is the reduction in the value of long-term assets, yeah, through normal wear and tear. So similarly, let's say you found you have a reservoir and you expect that there'll be certain quantity of oil that will be generated from that reservoir. Now, in a particular year, if you have actually lifted some of it, then the reservoir's value will go down. So what we have got here is an example. So proved developed reserves, let's say oil, with 2,200,000 barrels at start of the year. The well is in production and 10,000 barrels have been lifted from it in the year. And $2.5 million have been capitalized as related infrastructure. So when you carried out all the exploration activities, there was wells and other costs that you had incurred, it amounted to $2.5 million, which you have capitalized as an asset. Why did you capitalize it? Because you expected that there'll be future economic benefits from doing all this work. So you capitalized it. Now, in that particular year, we have lifted 10,000. Yeah. And in total, we expect 200,000 to be lifted. So the 2.5 million needs to be reduced in value because that those assets value has now gone down. You've actually lifted some oil. So what you would do is to calculate the depreciation, you would take the 2.5 million and say we have lifted 10,000 out of the 200,000. Yeah. So that will give you 125,000. So what effectively happens is the value of the asset, which was 2.5 million, is reduced by 125,000, and that 125,000 is your cost, because that is effectively the consumption of the asset to generate revenues. When you lift and then process and sell, you will generate revenues. So those revenues and the cost is matched. It would not make sense to just take all of the 2.5 million as an expense when it is incurred, when the expenses are incurred, because here we are going to generate benefits from that expenditure in the future. So depreciation here is based on the units of production, how much you produce. Based on that, you depreciate your asset. In some instances, like motor vehicles, buildings, you just depreciate over a period of time because they, even if they are not used, their value can go down. Buildings would have long life, so their value will go down over a long period of time. So this is depreciation, normal wear and tear. Yeah. Now, this is British Petroleum. I'll give you some international examples. We will be going through that. Don't get too worried about all the numbers over there. I just want to point out certain things in here. So first of all, this is British Petroleum. It is for 30th of June 2020, so quite recent. Now, British Petroleum has a year end of 31st December. So they prepared their annual financial statements from January to December. In India, it would be from April to March because that's what Indian companies follow. Now here, these are interim reports. Yeah, so this is from the interim report, which is for the 6 months to 30th June 2020. Now, what you will find, let's just go through a few things here. So first, we've got sales and other operating revenues. And you can see here that in the first half of 2020, which is 6 months from January to June 2020, the revenues were 91,326. So that is actually $91 billion. But the same 6 months in the previous year, it was a lot more. And the reason for that fall in revenue is mainly going to be the impact of COVID-19. Yeah. Obviously, we all are using less in the second quarter, which is the April to June period for BP based on this interim report. What you will also find is the different sources of earnings. So, you've got here earnings from joint ventures, associates is again where you have another partnership with another entity in which you have an interest, some interest income, and so on. And then you have the different costs. So these are all costs, and you can see here depreciation, depletion, and amortization, which is what we discussed on the previous slide. But what you will also find is impairment. Yeah? And we'll look at that in a bit more detail because it's quite relevant right now. And you can see that the impairment, how that has changed. So the first 6 months of 2020, about $13 billion of impairment recognized in the profit and loss as an expense. Same 6-month period previous year was only 1 billion. Now this is the impact of COVID-19 again, and we will see what BP has mentioned about it, because what you can always do is go to the note reference here, note 3 in their interim report, and that will give you a bit more information about impairment. They've also got here exploration expense, where more details are in note 4. And this could be to do with also assets which, they recognize they incurred expenditure on, and perhaps then they've not found any oil. Yeah, so they have to write it off because there are no future economic benefits. Again, from a point of view of a reviewer, one thing you may want to refer to is this earnings per share. So earnings per share tells you if you were a shareholder in BP, how much have you made per share. And you can see that there is a significant difference. There's actually a loss per share in terms of cents. These are all in US dollars, loss per share in terms of cents. And again, this is because of the impact of COVID-19. Yeah. This is for the 6 months to 2020. Don't worry about everything else, but basically this is an example of income statement. You've got your revenues, you've got your costs, and then it gives you your profit figure. How much have you made? How much have you earned? So something to look at here. The balance sheet, again, without going into too much detail, just to recap what I said earlier, remember the balance sheet has assets, which is what you own, control. It has liabilities, which is your obligations to pay money. So you may have taken loans from the bank, or you may have purchased equipment or goods and you have to make payments for that, and so on. So what you will find here is that there's total assets in the balance sheet that BP has got at 30th June. Remember, balance sheet is as at a particular date. So the total assets are $263 billion. And assets always equal liabilities plus equity. Yeah. So if we look at the liabilities, the total liabilities are 180 and the total equity is 82, 83 billion. Yeah. So just going back, your assets are 263 and you've got 82 and 83. So assets always equal liabilities plus equity. And liabilities and equity is like sources of financing. Yeah. As I said earlier, you can, if you want money to fund the exploration activities, you can either take loans or you can raise finance from the shareholders by issuing shares, equity shares. And then the investments are your assets effectively. So what you want is your assets to be more than the liabilities, and equity is a representation of the net worth. Remember, it's not market value. Equity is not market value. It's the book value of that net worth that you will find. Yeah. So I mentioned earlier about impairment that BP has recognized huge amount. And the reason they have recognized this impairment is COVID-19. But what they have actually said is quite interesting. And they've said that there is a growing expectation that due to COVID-19, the pace of transition to a lower carbon economy and energy system will be quicker. So as a result of this, they have revised their expectations about the oil price, oil and gas prices in the future. And hence, they have said those assets will not generate as much revenue as they originally expected, and hence they are worth less. So obviously, if the oil price is low, what you would say is that the assets value is going to be low. Yeah, oil price is low, the assets value is going to be low, and hence, you will have to impair those assets. And here they have actually also provided the revised price assumptions to the year 2050 for Brent oil and the gas also. Yeah? And they have obviously revised it. And what they have said is the revised assumptions for the next 10 years are lower by approximately 30% for the oil and 16% for the gas than what were expected, what were estimated at 31st December. So BP annual report, remember, 2019 is 31st December 2019. So how much has changed in the last 6 months? COVID-19 has business impact, and that translates to financial impact also. And then they have mentioned here specifically about upstream segment. Impairment charges in the upstream segment were, if you take the whole of the half year, which is January to June, they recognized a charge of almost $12 billion in the upstream business. And then they have mentioned why that those impairment charges arose. They relate to producing assets, and the main reason for that was the changes in the oil and gas price assumptions, and wherein there has been an impact. So what they expect is that those oil and gas infrastructure assets will not produce as much revenue as they expected earlier, and hence they have written down the value of the assets. And then they've also mentioned a bit about exploration expenses and the amount that has been written off, which means a cost and expense in the profit and loss. It reduces your profit. And the exploration write-offs arose because of the management's reassessment of expectations to extract value from certain exploration prospects due to changes in long-term strategic plan and changes in group's long-term price assumptions. So obviously a lot has changed because of COVID-19, where we may have thought, well, we'll continue to sell oil and gas and generate revenues for a long period of time, but now that may not be the case, or what we get as revenues would be lower, as I mentioned earlier, because the oil price assumptions have changed. The idea here was to give you until now an introduction to assets, and then a bit about depreciation, which is through normal wear and tear, and impairment, which is a more permanent reduction in value of assets due to abnormal circumstances. Now, you may have heard about Enron. This is a big US energy company that filed for bankruptcy in 2001 due to fraud. The reason financial statements are important, and it's important to project the correct figures in the financial statements, is because that's what the external world sees it. Yeah. Now, Enron was involved in a fraud and they ended up in bankruptcy. But you can see here, when you look at the figures, this is their revenue. Yeah, this line shows their revenue. Revenue is your sales or turnover. So how much have you earned by selling goods and services? And from 1995 to year 2000, you can see the significant jump in revenues. And this appears very unusual. It was actually unusual. What they did was they did a lot of creative accounting techniques to bump up the revenue. So they, some of them are mentioned here, but they recognized revenue income that was not earned. They recognized revenue or income too soon. There were expenses or costs that they hid. They did not recognize them, and so on. And by doing that, if you think about the top Fortune 500 companies, look at the rank in 1995, 141, and 2000, it is 7. Yeah, so huge jump. But this was fraud. Now, if you look at financial statements, would you be able to detect this fraud? Yeah, they did apply creative accounting techniques at that point in time, but since then a lot of these standards on accounting have changed, and as a result it will be difficult to do what they have done, what they did then, now for companies. But companies still do apply creative accounting techniques, and it's really, you kind of placing as an external person reliance on management and the auditors who review the financial statements to ensure that they show a true and fair view. But again, the point here is to highlight that if you see anything unusual, then it should raise questions as to how they have generated that revenue, what parts of the business have generated the revenue, and so on. When it comes to recognition, and we are slowly moving into exploration activities now. So when it comes to recognition, there are different accounting frameworks. So IFRS is the International Financial Reporting Standards. They are principles-based standards. There is less about exploration activities in those standards, but those standards are used widely. So basically, these are standards on how revenue or costs or assets should be recognized and how they should be measured. US follows US generally accepted accounting principles, GAAP, rules-based, but they are more developed when it comes to accounting for exploration activities. And sometimes for smaller companies, you might find national accounting standards also. So UK, India have those accounting standards also for smaller non-listed companies not listed on the exchange. But IFRSs are most developed The reason we have standards is to ensure there is transparency and consistency in how the different elements like revenues, expenses, assets are recognized, which helps investors and reviewers and users of financial statements. So this is what Hans Hugger was the chairman of the International Accounting Standards Board that publishes IFRSs said. But IFRSs are used in 140 plus countries, jurisdictions. So more than half the world uses IFRS. And it just gives you more confidence because if you look at financial statements of, let's say, British Petroleum and compare it to Royal Dutch Shell, both prepared under IFRS, then it will give you more confidence when it comes to comparison. You can compare the impairment perhaps in BP with the impairment in Shell, or the profit or loss in BP with the profit or loss or earnings per share in Shell. So it just gives you more confidence when there is consistency in how transactions are recognized. So moving on to exploration activities, upstream business, as you all would know very well, the key risk here is the large capital investment that is required. How much does it cost to drill? Even a meter, runs into hundreds, thousands of dollars. So there is uncertainty after incurring huge amount of costs around finding oil. Yeah. So you might have a huge cash outflow, but not find oil. There's uncertainty there. High risk, but the rewards, if you find oil, the rewards are high. When an oil company says, oh, we found oil in the North Sea or in any part of the world, you see its share price goes up. So there's high risk, but there's huge rewards. Operations can be very complex, but there's also a political side to it, strategic value that is there to the government. And often we see these production sharing contracts and joint ventures in the upstream business. There's a environmental impact could be adverse. And obviously, more recently, the COVID-19 impact has also been seen. We saw that in BP's financial statements with the write-offs on impairment and exploration expenses. And if you think about the whole cycle, then there is perhaps a prospect. So you do a bit more work, acquire data, submit proposals, and then if you think, look, it's worth carrying out some work to determine if there would be oil or not, then you acquire interest, buy a license to drill, carry out exploration work, and then do appraisals, evaluate results. And then if it is a dry hole, if you think there's no oil after all this, you abandon it, suspend it. But if you do find oil, then you carry out development and production activities. And this might go on for a number of years if you find oil, 15, 20, 25 years. But at the end of it, you will then decommission because you found all the oil that was there, and you've developed, produced, and then at the end of it, you will close. So there's a cycle that you follow, but exploration and evaluation is where the risk is, because all your drilling activities or non-drilling activities that you do, you may not actually find oil. So when it comes to financial reporting, financial statements in upstream activities, we need to consider the costs incurred for exploration and evaluation. Are they assets? Are they expense? Development expenditure, borrowing costs, depreciation, we've touched upon that, revenue, reserves, and production sharing contracts. And midstream, downstream, the key points are product valuation, revenue recognition, depreciation of downstream assets. And then there are certain sector-wide issues like leases, decommissioning. Remember, decommissioning can be a huge spend, impairment, Acquisitions, one oil company acquiring another oil company, joint arrangements like production sharing contracts, joint ventures, royalties, functional currency. Is it dollars? Because that's still the, currency in which oil is quoted, price is quoted, transactions happen, or should it be rupees, for example, if you're in India? And financial instruments like managing risks through using derivatives and so on. But we're not going to go into the details of all of this. It's just to give you a flavor of what all could be the financial reporting considerations. So what I'd like you to do is just think about this one here. Which one of the following is a measure of the number of years that production could continue at the current rate if no new reserves were added? Yeah. So have a think, which one of the ratios do you think is a measure of what is? So when you have oil and gas financial statements or financial information about oil and gas companies, how do you compare them? Yeah. And one of the ways to do is calculate certain ratios. And the answer here is the reserve life ratio, which is effectively looking at the total proved reserves. So proved is where you are certain you will find, you're going to find oil, lift oil, and earn revenues. So proved reserves, let's say at start of the year, and you divide that by the production. So if you know that there are proved reserves, let's say 100 million. Yeah, there's proved reserves of 100 million and you have produced 10 million. Effectively, it tells you that you will continue for 10 years, even if you did not find any more oil. Yeah, no more reserves were found. So reserve life ratio can be used, and you can, based on some of the reserves related disclosures that oil and gas companies make, you can compare that between BP, Shell, Saudi Aramco, and so on. Obviously, Saudi Aramco is in a different league, perhaps, but you can do that comparison. But there are other ratios also that might be relevant. Now, are you replacing the reserves so that you're producing, or what are the average reserves per well? Yeah. So again, that can provide some useful information. So exploration costs are incurred to discover hydrocarbon resources, and the IFRS 6 is the international standard on exploration and evaluation of mineral resources that drives how it should be recognized in the financial statements. But as I said, there's not much in the international standards. It effectively keeps it quite open. But what it says is exploration starts when the legal rights to explore have been obtained. And it is the expenditure after that which is a part of exploration costs. Anything before that, before obtaining the legal rights to explore, is expensed unless you've actually acquired some other intangible assets or rights. Evaluation costs are incurred to assess the technical feasibility and commercial viability of the resources found. So are you actually going to be able to lift oil? Is it of the right quality, and so on? So we're looking at exploration and evaluation. And the key point here is, do you expense it? Expense means you take a... I'll start with the provisions. Provisions is another thing that you should look at. There's uncertainty here in amount or timing of payment. And that's why it's called a provision, but you do expect an outflow of cash in the future. So it's a liability. Now, I'll give you an example of BP. Some of you may know that about many years back, there was a oil spill. Yeah, there was a Gulf of Mexico oil spill and huge claims against BP with regards to that oil spill. So there were litigation claims. You can see that in 2019, there is still some amount, but that ran into billions earlier on. If you looked at 2010, 2012 financial statements, there was provision worth billions with regards to that. So provision is when there's a legal case against a company. That's what litigation claims are. And you've gone to court and you expect that perhaps you may have to make a payment to settle it, but it depends on the outcome of the court case. There could be environmental provisions because of the adverse impact that the business had on the environment. There could be claims and you may have to make payouts. But the big one in oil and gas and the upstream business is the decommissioning. And this is to do with, oil rigs, for example, that have been set up. The oil rigs that have been set up when all the oil has been lifted, extracted, you will have to decommission those and remove those, and there's a huge cost that is involved. So you can see that the decommissioning provision that has been made is huge, and that is the bulk of the provision that British Petroleum has got in the financial statements. But remember that decommissioning provision is a future cash outflow, and the other side of that is effectively going to the asset. But the provision reflects how much they would need to incur. And a lot of it, as they have disclosed, is non-current, which will be after 1 year, maybe even after 10, 15 years. So I mentioned about decommissioning. So UK North Sea oil fields, you all would know about. So the global decommissioning spend over next 5 years, and this is recent energyvoice.com article, and as a result, partly of COVID-19 also. So it says UK is poised to lead the way as operators increase in spending on North Sea decommissioning work amid low oil prices. Yeah, so due to low oil prices, they are going to probably decommission earlier than what they originally thought predicted. And Britain is in line for nearly 80% of the 14 billion pounds it estimates could be spent on removal projects in Northwest Europe over the next 5 years. Exploration production budgets have been slashed due to the COVID-19 pandemic and sent oil prices tumbling. Few profitable investment alternatives. So you kind of say, okay, well, we're going to decommission some of the projects. We're not going to do as much work as we expected. And then there's also a bit more here, is the value of the market worldwide on decommissioning, 34.5 billion. And how much the European decommissioning sector could grow because of the low oil prices. So again, the impact is you decommission these things faster, but decommissioning involves cash outflow, so you need cash for that also. And once the evaluation activities are completed, if you think that the property is commercially viable, you recognize an asset. And if it is not commercially viable, then you will mostly take it to P&L as an expense, unless you follow the full cost method where you analyze on a country basis rather than a property or field basis. But again, you have to test for impairment, whether you are going to recover the value that you are recognizing of the asset. So impairment is a write-off. Just a quick run through 2 or 3 points and then I'll stop. But here we've got an example. Entities drilling a new well in the development phase. It has drilled to 0.1, as you can see here. 0.1, and incurred costs of $2 million, but no reserves were found. And then they do some testing, geological study, and so on. And they realized that they could sidetrack. So they could sidetrack here. And instead of drilling an entirely new well, they could sidetrack from the existing well and find reserves at point 2. So the question is there any cost that should be written off? And if they actually find oil at point 2, as you can see, then no, everything will be capitalized. It will be an asset. And then as oil is lifted, you will start to reduce the value of the asset through depreciation. Obviously, COVID-19 has had a huge impact. This is just a statement from Bill Gates in his TED talk that what could kill 10 million people is not war, but a virus. And this was in 2015. But what is most important takeaway, I think, is the impact it has had on oil and gas companies. So less exploration, perhaps change in future strategic plans, less dependency on oil, faster move to low carbon resources, and so on. And a key question to ask right now is not about how much you are earning or how much profits or losses you've got. How much cash do you have? Do you have cash to continue in operation for the foreseeable future? So cash is king. Do you have cash to carry out exploration activities is a key question that you would ask. And what oil and gas companies would look to do is preserve cash right now. So BP issued this update wherein they said that they had expected capital spend to be around $12 billion in 2020. Now they expect it to be 12 billion, which is 25% below the full year guidance. And they have said we are going to reduce our spending on the upstream business by $1 billion and downstream by $1 billion to preserve cash. And lately, they've also reduced the dividends they pay to the shareholders because all this helps preserve cash in the business, which is what we want due to COVID-19. I'll just touch upon production sharing contract, just the economics of that. Again, there's a few numbers here, but don't worry too much about it. So here we've got some information about the production and how the revenues, cost, profit should be shared. So here we've got an operator, a government oil company, and the taxation authorities. And the agreement is that the government gets a royalty of 10% of production. Profit share of the operator is the private company, oil company, is 55%, and the government oil company's profit share is 45%. Yeah. So cost oil, which is to do with the recovery of cost, is limited to 60% after the government's royalty. Any recovered cost can be carried forward to future years. And then you've been given the different cost components, operating expenses, exploration, development, and how it should be shared. And then you've actually been given the exploration cost incurred, development costs, operating costs, production, sales, and the price. Yeah. So just to be clear here, you've got production sales of 30,000 at a price of $97. So 30,000 times 97 is effectively your revenues. Yeah. You selling 30,000 at 97, that is your revenue. And what we are saying here is 30,000 times 97 is the total revenue, out of which that's also the production. So out of that, 10% should go to the government as royalty. And then you've got these different costs that you've incurred should be shared between the operator and the other upstream or the government oil company. And you also have a profit that will be shared. So without going into much detail, what happens is you've got revenue of 2917, which is effectively the 30,000 times 97. So 2.9 million, and 10% of that is the royalty to the government. Yeah, so they get the 10% royalty. The remaining is the 2.6 million, and the limit on cost recovery, or the cost oil, the compensation for costs incurred by the operator or operators is 60%. And then the various costs are allocated between the upstream company and the government oil company. So you get the total cost oil, which is actually less here than the 60%. So we don't have to worry about it. And then you get the profit. The remaining is the profit oil. So what the production sharing contract, if you think about the economics of it, involves is what is the revenue, how much is the royalty, how are the costs apportioned between the upstream company and the government oil company, and this should all be in the contract. And then how much profit accrues to the government, to the upstream company, and the government oil company. So when you have that, they'll be recognizing a share of revenue, share of costs, and profits. Yeah. So just thought highlight the economics of how the production sharing contract would work. Yeah. Right. So that is it from me. What I'll do is I will open it up to questions. As I said, feel free to connect with me on LinkedIn. And it's just about a little bit here about what we do. I mean, apart from financial training, we also have a managerial development program, which is for young professionals and managers. It's an e-learning program, which you do it in your own time, in your teams. And also we do other courses on blockchain, cybersecurity, data analytics for finance professionals. But what I'd like to do is open it up for questions. So feel free to ask questions now.
So the participants can they can unmute them. Those who are willing, those who have a question can unmute themselves and ask their question to so. You can also write your questions in the chat box, so we'll read it out to sir, so he'll
Yeah.
answer your doubts or questions. Okay.
Yeah.
We have a few questions.
Okay.
So, like, first question is, what are accruals?
Okay. Yeah. So a good question. What I'm going to do is let me just bring up this part, and maybe it's easier to just explain it. So you can see a blank screen. Yeah.
Yes, sir.
Yeah. Okay. So basically, accruals. I'll give you a simple example to explain it. Let's say we're looking at a period from January to June. Yeah. And what happens is during this period, let's say you've rendered some services. Yeah. Or you purchased goods or services. Let's say you purchased goods or services. Yeah. So I would say, let's say you purchased goods. Yeah. Now, at the end of June, you have to prepare your financial statements. Yeah. And you have purchased goods for which you have to make a payment, but the supplier has not sent you the invoice. Yeah, so you won't make a payment until you've received the invoice. So here you know that you've purchased goods, during that period, but the invoice and the payment will be later. Yeah, invoice and payment will be later. So here what you have to do at June is recognize those goods that you purchased. It could be an asset, it could be an expense, and then create a liability, which is referred to as accruals. Yeah, it is not a payable because you've not yet received the invoice, but it is an accrual. So you know the amount and you have to pay for it. Yeah, but in the future, if you had received the invoice, it's a payable. Otherwise, it is an accrual. So it is effectively, you can take it as from a reviewer's perspective, almost take it like a payable. You have got something and you have to make payment for it. Similarly, you could have accrued income. You have sold something and you need to raise an invoice to receive the money. It would be accrued income. Yeah, does that make sense?
Yeah. Yes, sir. So we have another question, sir.
Yeah.
So the next question is, what is the difference between capital expenditure and the revenue expenditure?
Yeah. So again, this is where the whole exploration thing comes up. So capital expenditure and revenue expenditure. So what happens is, let's say you incur 100,000. Yeah. You incur 100,000 of expenses, exploration expenses. Yeah. Now, what you would do is, let's say one option is you have it as capital expenditure. Yeah, this is, let's say, year 0. And then here you have year 1, 2, 3, 4, 5. Yeah. And if you recognize it as a capital expenditure, you will have it as an asset on the balance sheet. And as you find oil, yeah, you will write it off to the P&L or income statement over a period of time. So you capitalize it, you recognize an asset and write it off to P&L over a period of time as oil is lifted. So at the end of 5 years, it becomes 0. But the timing of recognition as cost, which affects your profit, is over a period of time. If it's a revenue expenditure, it effectively means it's recognized as expense in that first year itself. So you probably carry out exploration work, you find there is no oil, you recognize it. But what also, and without having to confuse you, is when you have recognized this 100,000 as an asset, it is your capital expenditure. And subsequently, in the 5 years, when you take it to P&L, it is effectively your revenue expenditure. Yeah. So revenue expenditure is to do with when you take it to the P&L. Capital expenditure is when you capitalize as an asset, which is going to generate future economic benefits. And this is very important because obviously it affects the profitability. And if you think about it from exploration per activities point of view, under the successful efforts method, you end up with expenditure recognized earlier because it is on a field by field basis, while under the full cost method, you will have to you capitalize it for longer on a country basis and then recognize it to revenue as a revenue expenditure. Yeah.
Thank you very much, sir.
Yeah.
We have a final question.
Yeah.
What can be done to ensure that no creative accounting takes place in different firms? Like we observed one in the US firm. So
Yeah.
what can be done to reduce this kind of these kind of practices?
So I
Sir,
think,
I would like to add up to the question,
yeah,
and
yeah.
I would also like to ask that how did they use the special purpose entities, and how the leadership fooled the regulators with fake holdings and off the book accounting practices?
Yeah, so I think Enron was a classic case, and there's been there's actually a YouTube video about what the management was doing, and there's also a book which has been published based on Enron's based on what Enron did. But in terms of creative accounting, does it happen now? Yes, it does happen. uh, it is the management's responsibility to prepare financial statements. So the management uses these standards, whether it is IFRS or whether it is US GAAP. They use these standards to recognize transactions. Now, the thing with IFRSs are that they are principles-based standards. So they say, okay, when should you expense all the costs that you have incurred in relation to exploration activities under successful efforts method? Well, when you conclude that it is a dry hole. And it is possible that the management might say, look, it seems like a dry hole, but let's do some more work. Let's not just take it to expense right now. Yeah. And that might mean deferring the recognition of expense in the P&L for some time. And capital revenue expenditure is a classic case here. But then you have auditors who audit the financial statements. So again, that is like a check on the management. All these creative accounting techniques, that Enron followed, I mean, they followed a number of them. And what they did was they set up special purpose entities, as you mentioned. So if you think of Enron, we said there was bogus revenue, obviously. They set up special purpose entities, which were actually kept off balance sheet also. Yeah. So there was a huge amount of entities which were controlled by Enron that were set up. They borrowed money and transferred that money to Enron, but what you have in accounting is a concept of group accounts, and Enron and all those special entities, purpose entities, should be consolidated as part of the group, but they did not do that. And I think that ran into billions and billions of dollars. It is also how they structured and recognized some of the transactions. So, classic cases where they perhaps show that they have sold oil and gas, but the way the whole structure is created, effectively, it is to recognize that sale transaction, but in effect, there is no sale because all the money is in some form then paid back to the effectively the purchaser. So it is how they structured. Then they had all these forward contracts on energy, which they valued, and they kept bumping up the values of forward contracts on energy because they used their own valuations. And that led to huge profits being recognized, increase in earnings per share, management being paid huge bonuses, and so on. The special purpose entities, I mean, now if you have entities set up, you would need to consolidate them. You wouldn't be able to keep it off balance sheet. So again, a lot has changed since Enron. New standards have come out. There's Sarbanes-Oxley Act, which is to do with internal controls and processes, that has come out as a result of that. So it is a bit difficult, but then you still hear of cases where there is fraud, there is creative accounting that goes on. I think I would say more sometimes aggressive accounting, aggressively recognizing revenues before they are being earned, or not recognizing costs as operating costs, but more as investing costs, which means you can capitalize it and take it to P&L over a period of time rather than taking the hit to the P&L immediately. Yeah. So yeah, but I suggest if you are interested with what Enron did, I mean, there's just you'll have to search for it, but I'm sure there's still a YouTube video on that which is freely available. Yeah.
Thank you very much, sir. Do we have any more questions from the attendees?
No, but if you have questions, do feel free to pass them on. I'll be happy to answer later. And as I said, feel free to connect with me on LinkedIn. You can see, my LinkedIn link. Yeah, if you just generally need to know anything or would like short course on financial statements or financial analysis, feel free to get in touch.
Okay, so I'll now I would like to deliver a vote of thanks to sir. I would like to thank sir for an enlightening and informative presentation on the topic. One of the major fallback for today's generation is its lack of financial literacy. Oil and gas industry, being one of the major pillars of the global economy, requires a critical analysis of its financial system. And we are grateful to you, sir, for this for clarifying this or demystify this area to us. We sincerely appreciate you making time in your busy schedule to deliver this session. I would like to also thank the participants for joining us in this session. Thank you, everyone.
Right. Thank you very much for coming, and stay in touch. Stay safe. Thank you.
Thank you, sir.
Very much, sir.
Thank you.